What's going on, investor family? Listen to the Stock Market Tour Guide podcast. I'm your host, Stock Market Jay, and I'm here to say today, bringing you some news you can really use. All right, guys. So now, as we continue our deep dive into the Boring Investor series, as we continue to provide that useful financial education, and this isn't financial advice, this is just solely boring financial education that's meant to give you a deeper understanding and help you navigate the world of investing. A lot of people don't understand that you have to learn the rules in order to win the game. And what you get here isn't going to be me trying to get you to join a community, get you to pay for any products or services. I'm looking to simply educate people. This is my form of giving back. I've done the fundamental research. I do my due diligence before investing and buying stocks and equities and silver, whatever other asset classes I invest in. And it's in the interest of the people to do the same, right? It is, of course, I believe our capitalistic duty as Americans. I'm in America, so it's our capitalistic duty to participate in the growth of this nation. And a lot of people can do that by way of creating a business, free enterprise. This is a capitalistic society, as well as investing in businesses as well. And if you don't know how to build a business, if you're not entrepreneurial, then what you do is you become an investor, right? You become a lender. We have become more consumer based and not producer based. So what the name of the game is going to be to get America to invest again, make America invest again is how I operate. I want everyone to be taking advantages of the capital markets, of the equity markets, of whatever asset class that suits you. And of course, the name of the game to do that is to make informed investment decisions. So today, what we're going to be talking about, like I said, it's just educational purpose. Today, we're going to be talking about how to pick winning stocks. And this is the method in which I go about picking the companies that I invest in. To date, I own about 10 stocks, and they all are similar in nature in terms of low debt or no debt, and a few different, of course, a large cash position and areas in which they're able to have similarities in terms of what they provide, like those intangibles and things like that. So one of the key components to picking a winning stock is going to be you want to invest in companies that have a talented management team. So that means the CEO, the CFO, and the COO, right? So the chief executive officer, which is the guy at the helm, which is the person making majority of the decisions in which the direction of the company is going to go in. A CFO, chief financial officer, basically the person that's governing the finances, and of course, chief operating officer, which is operational based. And you need a talented core of managers because, of course, they're navigating these companies' decisions. They're navigating these companies' ability to perform well. If it's not for these key group of people, now don't get me wrong, you still have the rest of the organization, the everyday employees and other members of leadership and things of that nature. But you have this core group of people that make up the management team that are going to be the drivers of the business. A solid management team can either make or break a company. If you have a business that doesn't have any direction, it's a good chance that it won't go anywhere or it won't have an upward trajectory. Or if it once was up, it'll likely begin to decline. Businesses have different cycles as well, from startup to growth to established to either they will decline or they will begin to reestablish themselves as a dominant player in that space and continue an upward trajectory. Here's the thing, management team matters so much because you have to be able to navigate the different nuances and the different cycles and factors that present themselves in business and in the economy on a day-to-day basis. So a good way to determine if it is a strong and talented management team is just simply the history of that team. How much history do they have in the field that they're in the niche that they're in the industry that they're in? How much experience do they have? Have they been in that industry for 20 years, 30 years? Have they worked with other businesses and were they the driving factor that allowed that other business that they were with to grow? Did that other company see growth with them? Have they navigated different economic cycles? Have they navigated a high inflationary environment? Have they navigated a low inflationary environment? Have they navigated COVID, for instance, or any natural disasters or any phenomena or things that can impact the business's top and bottom line, which is its revenues and earnings, right? Having a talented management team is what is the captain at the helm. That's one of the drivers of the engine to an amazing business. And you want to ensure that these management teams are able to produce a return for the shareholders. That's why we invest, is to return, to have value return to us, the shareholder. ROI, ROE, return on equity, return on investment. You want to return on the dollars that you supply in these companies with, because the money that you invest in a stock actually shows up on a company's balance sheet as debt, which suggests that you're lending them money in order for their business to grow. So a talented management team, navigating different economic cycles, navigating different environments and geopolitical factors. Right now, CEOs or management teams as a whole are having to navigate tariffs. Okay. Tariffs, as we know, are inflationary by nature. And then, of course, just being able to, whether it's through supply chain restructuring, ensuring that you're lining up your supply chain in a manner in which you're able to get lower costs for transporting goods and services, whether it come from overseas logistics to get raw materials and different components of creating a product or service in the United States, especially if you're a multinational business. And of course, having the pricing power to be able to know when to increase prices on which items. And of course, in terms of, let's say, structuring those costs. Or are you going to be able to increase those prices, and then at the same time, maybe it's going to be discounted prices and things of that nature? How are you going to navigate that? Because, of course, me personally, I love companies that don't offer extreme and exuberant discounts. I don't want you to discount too many items because, of course, if that's going to happen, then you're essentially going to be leaving money on the table. Discounted items means that you're not earning as much capital on whatever service or good that you're selling. So those are the different components to that make up management team. Just essentially being able to navigate the current economy, navigating the current environment that we're in terms of, like I said, high interest rate, low interest rate, something that where the economy is essentially going completely nuclear, or just completely been turned upside down on its head, like during COVID. Who could have imagined that your business would have to go basically to an e-commerce business because the stores were essentially closed and the world was shut down? You have to be able to navigate that. Some businesses went out of business, and some companies actually grew during COVID because they were properly navigated. Management teams created a well-devised plan, and they executed it flawlessly for the businesses that were able to grow and swallow other companies and continue to grow their earnings during those times. Because no matter what time we're in terms of pandemics or the Great Depression or the dot-com bubble or the housing market bubble crash and different events throughout history, management teams have to navigate these things. And the sign of a strong company starts at those points, because if you can't navigate those different phenomena and scenarios, then guess what happens? You go out of business. And the name of the game is to turn a profit. So management teams is going to be factor number one. They make all of the difference in terms of picking a winning company. Okay. You want to know who you're investing in. You're not just investing in a corporation, you're investing in a company that's run by people. And you want to make sure that they're making wise decisions, because, of course, any scandal, any lawsuits, a lot of different things can impact the company's trustworthiness and ability to return value to a shareholder. Another different thing is going to be debt to equity. This is something that I look for when I'm investing. How much debt is a company holding in comparison to the equity that they have? And of course, equity is just going to be cash equivalents, money that they got coming in or that they just have access to on a daily basis. And here's the thing. The reason being is because debt. Debt can be used as a tool to scale a business. So companies use debt to grow, and debt can be healthy. Businesses can use it in a healthy manner. Now, if they're just continuously adding on debt, if they're have way more debt than they have liquid cash and total assets on hand, for me, those are red flags. I don't particularly take too kind to a business that is over leveraged. That means you might be relying on debt too much to grow, and that you might not be as fundamentally sound as, the people might be led to believe. So, like I said, having debt is not a problem. I prefer companies that don't have debt. Majority of the companies that I own in my portfolio don't have debt. Maybe 3 or 4 of them out of the 10, maybe 3 or 4 carry debt. And that's not a problem. Okay. As long as they're using it in a wise and healthy manner, as long as they have a debt repayment plan, because you have long term and short term debt. As long as you have a debt repayment plan, as long as it's structured soundly to where you can continue to run and operate the business on an optimal level, totally fine. It all's well that ends well. But the thing is, what a lot of investors don't understand in terms of debt is going to be that, let's say a company goes out of business. When they go out of business, they have to pay their creditors first before they can pay you, the investor. And then you have inside investors, angel investors, and different institutional investors that they have to pay next. And then you get to the common shareholders, the preferred A, preferred B, the common shareholders. Then those people get paid next. So if this company has 100 billion in debt and they only have 50 billion in total assets, you're not getting paid. If that company goes out of business, you won't get paid as a result of their lack of financial discipline. I want to make sure that I get paid. You got to look out for you. The name of the game is to look out for me, the investor. I want to make sure that I'm able to protect my money, protect my investment. And in order to do so, you want to be investing in companies that aren't over leveraged. I would rather invest in a company that has, and I actually do, Build-A-Bear. They only have only $28 million on their balance sheet, but they have no debt whatsoever to speak of. I would rather invest in a company with no debt that is able to grow a cash pile, that is financially solvent, as opposed to investing in a company that has, like I said, 100 billion in debt and only 50 million or 50 billion in cash. That's kind of scary. It puts me on edge as an investor in terms of, man, because you have to be able to navigate that debt, because you got to think about it. You have to pay these creditors your money, just like how you in your everyday life, if you have a car note, if you have rent, if you have credit cards, if you have loans or whatever the case may be, lines of credit, you have to pay those lenders that you borrowed money from regularly. And if you don't, guess what happens? They're coming for you. They're going to liquidate your assets and different things like that. And it can get kind of tricky. So I prefer personally to invest in companies with little to no debt. If they do carry debt, I'm okay. Hopefully it's a 1-to-1. Like, let's say if they got 100 billion in debt, at least in total assets and cash equivalents, I would hope that they would have, let's say, 150 billion. So that way they can pay off the creditors if something were to happen, still have enough of a reserve to where they can return value to the shareholders. And then whatever happens to the company after that, I don't care, at that point, essentially. So debt to equity is a big one. Strong financials with a large cash pile. I love businesses that have strong financials, and whether that's going to be their balance sheet, their income statement, the different levers of the companies that makes up their accounting and their financials and stuff. So I would prefer that a company has strong financials, and a good way to determine if a company has strong financials, and jot this down because this is going to be a key component. This is essentially a company's engine, which is the operating income, earnings, which is known as the bottom line. It's the bottom line on the balance sheet. The revenue, which is the top line of the balance sheet, and then of course free cash flow. Revenue is just essentially all the money that the company made from all of their business operations, just everything that they were able to bring in. Doesn't matter if it was from investments, doesn't matter if it was from tailwind of capital that they got, that something that they offset years ago. It doesn't matter. It's what they brought in as a whole. Earnings is essentially going to be the net income. That's what's left over after they paid everything. It's just what they have left. This is going to be a company's earnings. And A company's earnings is going to be a key component in that company's financial health. And you want all of these levers to be increasing quarter over quarter, year over year, okay? Free cash flow is basically what's going to be left over after a company has done everything that they need to do as far as operating expenses, capital expenditures. It's the net cash that's used to grow the business. This is what they use to be able to reinvest into the company and return value to shareholders. This is a key component with the free cash flow is a big lever that you want to make sure you're able to check the box on this because this is how a company pays dividends. This is how a company buy repurchases shares. And of course, share repurchases is good because of course you're essentially taking away all of those extra shares. When companies have a surplus of outstanding shares, you're diluting the shares and you're diluting the actual stock itself. So when they buy back those shares, and you want this to be done intelligently, you don't want companies to just be buying back shares when the stock is overvalued. That's not a smart way to use that money. I would rather them do it when the stock is undervalued, repurchase those shares, take some of those shares off the market. The stock price typically goes up, earnings typically increase, and of course, more value is returned to the shareholder. Mergers and acquisitions, buying other businesses, and of course, vertical and horizontal integration is possible with that free cash flow. Like I said, it's the money left over after everything, those cash expenditures, and of course, operating expenses as well. And then, of course, being able to like for marketing and research and development, that's a big one right there. Marketing is how the company gets seen, whether it's advertising dollars, whether it is, putting their self out there in front of people, billboards, whatever the case may be, for people to see them. And of course, research and development, which is whether it's going to be creating new products, creating new services, no matter what goes into that, whether they're innovating technologies and things like that, they have to be able to be allowed to do those things if they want to continue to grow. So free cash flow is a big one. And then of course, operating income, which is going to be the revenue minus like COGS, cost of goods, salaries, utilities, rents, things like that. Basically, this is just money earned from running the business. This is a good key measure of what the company is actually bringing in from the actual business operations. Okay. In those four components create a business's ability to be financially prudent and solvent. Because you can go to a company's financials are all public record. You can go online to their investors and relations page or just do a quick Google search and you can look and see is a company growing earnings, free cash flow, operating income, and of course, revenue on a regular basis, whether it's quarterly or year over year. If the business is doing that, it's a great chance that you're investing in a good, strong business. So that's the name of the game. If they are doing that every single year, it's almost impossible to be invested in a bad business. If they're growing those areas regularly, I'm not saying that don't look for other areas of growth. Don't look at other financial data points that suggest growth or that suggest that the company isn't doing as well as it should be. But those are the four main key components to what's driving a business's growth. Another way that I pick stocks is going to be, are they vertically and horizontally integrating? Vertical integration is just deepening their pipeline of what they already do, adding more products and services that make sense within the scope of the business, the industry, and the niche that they're already in. And then, of course, just kind of solidifying their self or their market capitalization, how much of the market that they own, their market share. That's a good way to measure how strong a company is. Horizontal integration is essentially going to be, let's say how Apple, their core business is going to be a hardware and a software, the iPhone, the MacBook, iPad, AirPods, Apple Watch. That's the hardware component. Software is going to be the iOS software that Apple operates with. That's their software, right? And then of course, they have the component of the business that has the savings account and the credit card through Goldman Sachs. They have the health portion of the business, the Apple Watch and different features on there is basically them moving into the health sector of the market and they're looking to get into the insurance space and different things like that. This is horizontal integration right here. These are just different components of the business that they're already in that kind of make up. These are just sums to the whole, essentially. And then, of course, another component to picking amazing businesses is going to be distinct competitive advantages, also known as moats. I love businesses that have an amazing moat simply because this is what wards off competitors. This is what keeps a company head and shoulders above everyone else that wants a slice of their pie. So when I speak of market share, that's how much share of the market that they have. You know what the marketplace is? It's buy, sell, barter. Whether it's taking up shelf space in retail stores or whether it's just how much of the total population is buying into your products, goods, and services versus your competitors is essentially market share. So with that, some have branding moat. Like when you see a company like Nike, you know that check, you know that swoosh, you know to just do it. It can be a form of intellectual property as well as the company's brand. Apple has a few. They have the brand. You see the Apple logo with the chunk out of the side, you automatically know it's them. They also have what's known as a switching moat as well, which essentially means that it is extremely hard to leave Apple. It's easy because they're integrated so deep with their product line. It's very easy to just sign into your iTunes account and automatically everything that you have is on your device, whether it's going to be a tablet, a MacBook, the Apple Watch, or your phone. You sign in with your whether it's an iCloud or a Gmail, whatever it is. You sign into your Apple account. You have your contacts, you have a calendar, you have your photos, you have your music, you have everything that you need on there. Is notes and different things like that. So if you were to leave Apple and go to Google, let's say, or go to Android, it'd be a little bit more difficult to get all of that information to transfer over. So it makes it harder to switch. I love companies that have a very sticky switching mode. That is awesome because it means that it makes it harder for people to leave them. So the likelihood of their whole consumer base just disappearing and going somewhere else is pretty slim to none, which is awesome. I love it. I personally like companies that have a subscription-based business models. That just makes it a little hard to switch. That's going to be kind of like a switching thing as well. Now you can get out of subscriptions, but if you have a very good thing with a very good company going on, why would you leave that alone? So having a distinct competitive advantage is awesome. Some companies have pricing moats, like Walmart. They're one of the stores that you can guarantee that you're going to be getting discounted prices. They're a discounted shopping store. They're so extreme with it to where if you find a price of the same item that's cheaper than ours, bring the proof and we'll match that price. It's not too many companies that are able to do that. They have the pipeline with the people that they're as far as the manufacturers and the different companies that they have structured agreements with to be able to price things a certain way to where you go there for the lower cost. That's an ideal moat because in today's economy, especially, a lot of people want the cheaper price. You'll go somewhere specifically just for the lower cost, having the exact same product or service, but at a higher cost. You'd rather have the lower cost. So pricing moats are awesome, switching moats, branding, intellectual property, and things like that. That's another moat, intellectual properties, meaning like, so Disney, their IP is essential for them. They have, right now, they have deal, a partnership with OpenAI. And of course, it's a licensing agreement with their intellectual property, whether it's going to be Disney characters like Mickey Mouse, things like that, whether it's going to be Star Wars, or whether it's going to be no matter what realm their intellectual property it is, because Disney has a few different, brands that are only for that is solely, but that's a part of the intellectual property. That's a part of the licensing agreements that come with doing business with them. You're able to use that and not be sued because if you use any of their IP without having a licensing agreement, they can sue you for it. So those are just examples of moats and things like that. Another way that I pick winning stocks is going to be what partnerships does this business have? Like I said, with Disney, they have one with OpenAI. You have companies like I own a stock in Udemy. They have partnerships with Indeed. The place where you go and apply for jobs and stuff like that. So the businesses that post jobs on there, they do training programs. If you know anything about Udemy, it's essentially a platform where educators go and they post courses and they teach different areas that are meant to help. That's the name of the game. A lot of companies have in the automotive space have partnerships with Tesla to use their charging stations because Tesla has a strong hold on the infrastructure and electrical vehicle space. Don't get me wrong, there are other companies that have electrical vehicles, but Tesla has so deepened its vertical integration in that sector that other companies, it's easier to just partner with them as opposed to building your own infrastructure and going in to compete with them, if that makes sense. So partnerships is going to be really big in terms of a company's noticeability and what a company is able to do because businesses do business with other businesses all the time. Even if they're seen as competitors, sometimes companies have to just bend the knee and just say, hey, it's more lucrative for me to deal with you than to try to do this on my own. And then, of course, at the same time, they end up, looking to build their own space in that regard. So let's just say a company like NVIDIA or AMD, they have their own chips. They're a manufacturer of chips. But of course, you have different companies that have partnerships with them, and Apple is even one, but they're in the process of making their own chips. So they're like, in the meantime, we're going to do this. We're going to partner with you. We're going to give you money in the interim. Down the future, down the road, I'm going to be able to do this myself. I'm creating my own infrastructure. I'm creating my own products and services to where I can be a player in this space as well and not just rely on you, which is the name of the game. Netflix, another company that I own, amazing company. If you're not an investor of Netflix, I encourage you to analyze the stock, do your own research, and make an informed decision of yourself on whether you should be investing into the company. They have partnerships with people as well. They have, of course, partnerships with the NFL. They have partnerships with the likes of Dave Chappelle, who only solely has his comedy pieces stream on there solely. They don't go in, they go straight to Netflix. You have certain things that go straight to Netflix. You have, like I said, the NFL. They have partnerships with them. They have partnerships with the NBA. This is what you want. This just lets you know the strength of a business. Who all is looking to do business with this business and how far ahead of they over their competitors. That's a good way to kind of get an idea of what to look at. Everyone is partnering with open AI right now. Everyone is. And it's actually a tool that people use to drive their stock price and create news. It's like as soon as they get a partnership with OpenAI, they announce it, and all of a sudden the stock is up 5%, 10% on the day just from announcing that news. Nothing changed with that company's fundamentals or financials, but since they announced that news of just simply a partnership, now all of a sudden, they're reaping the benefits of it. Another way that I pick winning stocks is just knowing what companies does a business own? Because this makes up, these are some parts to the whole. So Meta, for example, another amazing business, they own WhatsApp, they own Instagram, and of course, Facebook. And so basically they got a stronghold on the social media and the connectivity that is going on. And they also have a partnership with Ray-Bans and Oakley, where they have the Meta, the glasses and stuff like that, the Bluetooth glasses and things like that. That's awesome. That's another form of partnerships. It's widely known. Of course, they have the AR and VR, like the metaverse thing. So this is just them vertically integrating, and of course, the partnerships and everything is just horizontally integrating and stuff like that. So these are examples of what you want to look for. Google, they own, of course, Google and YouTube. Gap Stock, they own Old Navy, they own Banana Republic, they own Athletica, and a few other brands as well. These are companies you want to invest in. So you want to know all the parts that make up the whole of the company that you're investing in, because stocks aren't just a number, a digital number on a brokerage app. Stocks are businesses. And it's in your best interest to understand the ins and outs of that business and be able to understand it and explain it to an 8-year-old. If you can't do that, and it's a good chance you shouldn't be investing in those businesses. If you don't understand quantum computing or cloud or AI to some degree, you might not want to invest in those companies, right? If you don't understand pharmaceuticals, you might want to stay away from that. A lot of people just invest in companies because it's online, fear mongering, right? Saying, oh, these companies are up 20%, 100%, this amount percent over the last 30 days. This is where you need to invest. Stock is about to go crazy, but you don't know why you're investing in that. You don't even know the parts that make up the whole of that business and that company. So you're essentially going to be at a deficit. If something happens to happen, you're going to be standing there looking crazy, holding the bag, wondering why you're losing money because you don't understand the business that you're investing in, right? Keep it simple, man. You don't have to sit here and invest in the latest companies that are trending and things like that. You can invest in boring, slow companies that have certain use case and that, you understand. That's the name of the game, man. And that will benefit you in the long run way more than anything ever could. Just putting yourself out there it won't help you. That's all I'm saying. Just know what you're investing in, understand the different intermakings of that company, what drives that company, how it's growing, who's their consumer base, who are their target audience, because companies know this. I hope that companies know this. And if they don't know that, then you probably won't want to invest in them, right? Another way that I pick winning stocks is going to be investing in not investing in, is gonna be listening to earnings calls. Earnings calls is gonna be a great way to determine if it's a winning stock or not, and let me explain. When you listen to earnings calls, companies tell you what's currently going on with their business and what they're planning to do in the future. They have earnings calls once a quarter, so every 3 months, they have for a year. So if a company says, "We have $100 million share repurchase plan, and we're planning to execute this over the course of the year." Every single earnings call, I am expecting them to get on there and talk about their share repurchase plan. I'm expecting them to get on there and tell me what they did with that $100 million to return value to me back to the shareholder. So how did they use this money over time? And if they have $100 million share repurchase plan, are they buying when their stock is overvalued? So that's basically just buying just to be buying, or they're making prudent efforts to return value back to the shareholder. And if they are doing so, awesome. When that happens, you can gauge and see if they're doing what they say they're going to do to you, for you, the shareholder. If a company says we have $50 million that we're going to pay out this year to investors in the form of dividends, and here you are in Q4 and they're still sitting on $40 million, it's like, hold on, why haven't you been paying investors their dividends? Are you like, why aren't you paying them as much as you said you were going to pay? What's going on there? You want to make sure that companies are doing what they say they're going to do. And another reason why I like earnings calls is because at the end of those calls, you have, whether it's analysts or whether it's people that represent different institutions, that essentially ask companies those tough questions like, hey, how are you navigating and mitigating the impacts of tariffs? Okay, so you did say that you've seen a decline in sales. Is this due to foot traffic? Is this due to consumer demand, or just is it due to the economy as a whole? What is driving that decline in sales? Right. So listening to earning calls gives you a bunch of clarity and a bunch of insight to what a company is doing, what they're going to do, and what they said they were going to do. It just helps you just paint a better and clearer picture of that company as a whole. You want to invest in businesses that do what they say they're going to do. Okay. I don't know about you, but me as a person, I don't want to be friends or in business with anyone that doesn't do the things that they say they're going to do. That's not beneficial to me, and it's not how I operate. The last component to how I pick winning stocks is going to be having an investment thesis. What this means is just essentially you want to know why you're investing into this company. So all of those different points that I just drew out for you, write them down, and you want to basically have like a 1 to 2 page thesis paper on why you should invest in that company. And of course, You want to have the inverse in there as well on potential reasons on why you shouldn't invest in that company, knowing their competitors, knowing their flaws, knowing drawbacks, knowing the stage of the business cycle they're in. This is how you make an informed investment decision. This is how you do the fundamental analysis. This is how you do your due diligence. And this is how you don't become one of those people that online say, hey, how do I know I should invest in this company? How do I know this is a good time to buy? Things like that, right? And then, of course, it's just a good way to have some checks and balances and just ensuring that you're making the right financial decision in terms of should you be owning that stock? Is it a stock worth owning? And in a way to gauge whether a company is under or overvalued is going to be three metrics that I use: price to book ratio, price to earnings ratio, price to sales ratio. And price to earnings ratio is that company's price in relation to the earnings that that company has. Okay. So if a company stock price increases and the earnings don't increase, two things have to happen. Either the stock price will come back down to where the earnings suggest it should be, or hopefully the earnings increase to where the stock price is. That way, you have a business that's growing fundamentally, and it's not just the stock is just, the price is pushing up because of outside noise or because of, because people are the drivers of the market or marketplace. The stock market is a marketplace. People are, it's buyers and sellers, and that determines whether a stock price goes up or go down. So ideally, any PE that's over 25 is probably considered overvalued. Every industry is different, right? Growth investors don't care about extremely high PE. I'm a value investor. I personally do care whether a PE ratio is high or not. Uh, Anything below 20, you're looking at something that's pretty undervalued, and that's ideal for me. That just lets me know, hey, in relation to the stock's price, the earnings suggest that this stock's price is relatively undervalued. Price to sales ratio is going to be the ratio between the current price of the stock in relation to the annual sales that that company is doing. So this is how much you're paying for this stock per $1 that this business earns. You don't want to pay too much, and typically two or below, one and below in certain industries on a price to sales ratio is ideal. You can Google the price to sales ratio. You don't have to do, and they have complicated and complex math equations to determine it, but you can just Google it. And I don't want to pay a rich premium for every dollar that the company is earning. If it's 1 to 1 or 1 to 2, I'm fine with that. Anything over that, depending on the industry, it might be too rich of a stock to own. You might want to look a different direction. And then price to book value is going to be the company's stock price compared to their book value as a whole, meaning the assets they own, the real estate, the equipment, the company vehicles, just the whole book value of that company, everything that encompasses that company's value in relation to the stock price. And typically that coincides with the PE ratio. If the PE ratio is high, or if the stock is trading at a 52-week high, it's a good chance that it'll have a pretty high PB ratio. This is a good way to determine whether a stock is over or undervalued. And a PB of 1 to 2 is ideal as well. So a PE ratio between 12 and 17. 20 is going to be the highest that I'm going to go. I mean, 25 is going to be the highest I'm going to go. I'm not even going to take it that high. And then, of course, on a price to sales ratio between 1 and 2, price to book between 1 and 2 as well. These are good ways to determine if a stock is over or undervalued. If it's undervalued and the financials suggest, or all of these other components that I just spoke about suggest that that stock is in good standing, then that's a winner. And you buy it right then. You don't wait. And you continue to buy until the story changes. So when you make those different components make up the story on why you're buying that company's stock. And if that story changes in a drastic way, it might be time to sell. That's how you learn. That's how you know when to sell, not when the price goes up because you want the stock's price to go up. That's how you sell when the story changes. So you take all of these different components that I just laid out. This is how you know if you got a winning stock. And that's the story that you build around the stock that you own. And That's how you know whether you should buy or whether you shouldn't buy. And if a company is overvalued, you don't want to buy high and hope it goes higher. You buy low and know that because of the financials, because of how sound the management team is, because of the distinct competitive advantage, because they have a low debt to equity ratio, because they're vertically and horizontally integrated, because they own multiple companies, or they have a deep pipeline, or because they have a bunch of partnerships, or because you understand that the stock is undervalued when you bought it. This is how you have confidence in your investments that you make, to where you're not asking, "Hey, is this a good company? Should I buy this stock? When should I sell?" Things I just told you when you sell, when the story changes, you built the story around it by doing the fundamental analysis and doing your due diligence. This is where emotional intelligence comes in to play at, because if you've done your research and you are confident in that research and your ability to do that research, if that stock price drops drastically, suddenly like that, if it loses 50% of its value, you're not going to be panic selling. You're not going to be one of those people that say, "Oh yeah, if it goes back to, I bought it at $20, it's at 10. If it goes back to 20, I'm selling." Like, bro, why would, like, you're not buying more? That means that you didn't do your due diligence and you don't know why you own that stock. Because if I own a stock and I've done my due diligence and it was once $20 and it goes down to 10, I'm buying more. I'm buying that dip because I understand that a stock's price can become detached from a company's fundamentals at any point in time. Whether that stock price goes up too much and the earnings aren't increasing with it, or if the stock's price went down and the earnings are continuously growing and the company is financially solvent and healthy. Man, it just might be economically the sector that the company is in, or just the economy of the world. People are scared. The markets as a whole are going down. We're in a bear market. Man, it's a time to buy. You buy undervalued stock of wonderful businesses and you hold for the long term. That's how you get the most bang for your buck. That's how you get the most return on investment and return on equity. And that's what keeps you in the game longer, and that's what has you gives you the confidence to continue to invest in the company that you're investing in, continue to buy shares of that wonderful business, and don't just put your money in and just stop investing. You don't put money in and say, "Imma wait for it to go up," and then just stop putting capital into the markets. You regularly invest. That's how you increase your return. And do your due diligence, man. That's the best thing you can do. Learn the language of investing if you're gonna play this game. Learn the language of money, because money goes where it's invited and it stays where it's welcome, okay? And do yourself a justice and just make sure that you're making wise investment decisions, okay? And until next time, investing family, peace.